Hey, good morning. Seems like I'm only doing these videos in the car, so I apologize about that. But I'm trying to do more video work, inspired by my friend Adam Taylor from eXp Realty, who has started recently doing videos every day. And I'm watching him, and I'm like, hey, if Adam can do it, I can do it. So I'm going to start trying to deliver more video content on a daily basis. Specifically for business and for commercial real estate. Hey, check out my new hat too, by the way, liking the digs. Anyway, wanted to talk a minute or two about debt service coverage ratio in commercial real estate. You may see this expressed as DSCR, debt service coverage ratio. And that's a very reliable rate to determine if a property is valued correctly or not. A lot of people will ask me, Scott, how do you know as fast as you do if a deal makes sense and if it cash flows? And that's because I use the DSCR method, which stands for debt service coverage ratio. That is a ratio provided by the lender. Every lender has a debt service coverage ratio, and what that is basically a risk tolerance ratio. So it kind of determines how well the bank is positioned in the marketplace. But on average, in a healthy market, the debt service coverage ratio should be 1.25%. When the markets are really more aggressive, like there's a lower credit risk or credit rating in the stock market and in the lending environment, then you're going to see those numbers fluctuate. But right now, and in general, 1.25% is the debt service coverage ratio. So what does that mean? Well, if you have a property and it's throwing off, say, 100 grand in income, the bank is only going to allow 1.25%, whatever that percentage works out to be, to go towards your cash flows. So if the property is not throwing off enough cash flow as it relates to the purchase price to even meet that debt service coverage ratio, then you know that they're asking too much money for that property, because no lender would then lend on that property. Also, you could then determine if in fact you're paying too much or too little in rent if you're the tenant, based upon that 1.25% figure. So that's how I do it. Take your net operating income and divide that by 1.25%, and that should be what amount of cash flow is going to go towards your mortgage payment. If it's lower, you're fine. If it's higher, it's not going to work. That's it for now. Talk to you soon. Thanks.